Is your business protected against the threat of malicious litigation and frivolous lawsuits? Are you sinking company profits into marketing campaigns that do nothing to contribute to the growth of your business? Bottled Business Sense provides practical business perspectives that uniquely emphasize both legal and media marketing strategies to protect and ensure the longevity of your business. Now, whether you're trying to provide a startup business with some level of stability or an established business with foolproof asset and estate protection, or simply attempting to get a better return for your business marketing dollars, Bill Bernard and Rick Moscoso will expose potential pitfalls to ensure the security and growth of your business, free from unwanted expense and the threat of litigation. You'll learn how to implement marketing and protection tools equal to those used by today's most successful corporations. Let's join Bill and Rick for today's Bottled Business Sense show.
Hey, good morning, everyone. Good morning. Welcome to the Bottled Business Sense show. Today is Tuesday at 10 o'clock Pacific, as always, and we want to welcome all of our viewers and returning listeners and new viewers to the show. I'm Rick Moscoso, one of your co-hosts today, and over on the other side, sitting in the dark, is Mr. Bill Bernard. Hey, Bill, how you doing?
I like the dark. Good morning. Good morning. It's been a rough night. I was up late, working late. So I'm going to be a little bit slow today, but that's okay. Bear with me. This is an important show, but it's also a very complicated and kind of a sticky show in the sense that the issues we're going to be dealing with today really need input from an estate lawyer, from a financial planner, and from a tax specialist if you're going to do this right. So we're going to talk about passing assets that are largely retirement account assets, 401ks and IRAs and things of that nature. And we're going to first talk about how you pass these assets through the plan itself, and secondarily, how you pass these assets should you want to use a trust. Because as you probably know by now, or you should, most people, generally speaking, don't use a trust to pass retirement accounts because retirement assets like life insurance and IRAs and 401ks pass to designated beneficiaries within that program. And so therefore, they typically don't pass by will or trust. These kinds of assets, unlike other assets that a person can inherit, are subject to income tax. So that brings them into a special category, whether you get them by way of the natural plan that designates you as a beneficiary or by way of a living trust. And that kind of a trust that we'll refer to today when we get to that portion of the program will be typically referred to as a stretch trust or a accumulation trust, a see-through trust, that sort of thing. So we'll get to that in a minute, but let me just first talk briefly about the plan and what these assets allow in general. You'll need to determine what your options are for withdrawing money if you inherit an IRA or a 401k. And non-spouse beneficiaries, so a beneficiary to one of these plans that are not a spouse, cannot roll over an IRA or a 401k. Typically, if you're a spouse, you may be able to roll over this inherited IRA. But of course, you'll have to check with your plan administrator to ensure what requirements they may have. And we're going to touch on that very briefly as well. Despite whatever the law says, you must remember that the plans that you're involved with, or that you inherit, I should say, may have special policies or rules attached to them by way of the plan administrator that you're going to have to follow. So let's generally talk about the plan that you inherit, a 401k or an IRA, and what your withdrawal options are. Typically, you withdraw the money right away. That's one option. Two, you must withdraw everything within 5 years after the date of the person who had the plan, if you're a non-designated beneficiary. What does that mean? That means if the person has a 401k or an IRA and they pass away and there's no designated beneficiary on the plan, it has to go through probate. And so as a result of that, you're going to have to withdraw that money within 5 years after the death of the person who held the plan. And it's typically by December 31st of the 5th year post that individual's death. Now, again, under some IRS rules, only certain beneficiaries can be called designated beneficiaries. And we're going to get into that a little more down the line. But right now, I want you to understand that you have the option of withdrawing the money right away. If you're a non-designated beneficiary and you go through probate, you have to withdraw it within 5 years after the death of the plan holder. And the third option would be to withdraw everything over the beneficiary, your life expectancy, if you have a stretch trust, which again, we're going to get into in a minute. But I wanted to outline the general 3 options that you have. Typically, you're going to fall into the first option. If you're a designated beneficiary, you're going to have to withdraw the money in a lump sum. So let's talk about a little bit more about if there's no beneficiary named, or if the beneficiary named has already died and there's no contingent beneficiary. The plan funds go to the decedent's estates. The fund will be distributed as a part of a probate proceeding because the designated beneficiary that was named was non-existent. In other words, that was a bad phrase. They weren't named, so there's no designated beneficiary. Or if there was, that person died, and there was no contingent beneficiary named in the plan. So consequently, you go through probate, and all of the money then needs to be withdrawn to whoever ends up with that inheritance within 5 years of the date of the plan holder's death by December 31st of that 5th year. Now, if you're a surviving spouse, and you can do a number of different things. You have 3 choices with your inherited IRA. You can designate yourself as the new account owner if you're a spouse now and you inherit one of these plans. You can roll it over into another account that you may already have existing for yourself, or you can treat yourself as a beneficiary and just take the money out. Let's briefly go over this 5-year rule to make sure you understand it, where there's no designated beneficiary. The rule means that when you're required to have money out of the account no later than December 31st of the 5th year after the owner's death. And again, this rule applies if you choose to take out use the option where you have to take out all the funds. And of course, that is in particular that is of particular importance if you're going through a probate proceeding, because you're a non-designated beneficiary. Now you've inherited these funds by way of probate. The 5-year rule is designed to leave you as the new beneficiary by way of probate with a period of time when you can withdraw the funds without tax repercussions. With each year of that 5-year period, you'll have a required minimum distribution that's based on a sliding scale for that year. So you have 5 years to withdraw all of these funds, right? You've gotten this money through probate. You were a non-designated beneficiary in the plan. You went through probate. Now you're the one getting the money. Let's use an IRA. Now you're getting the IRA money. You must withdraw it within 5 years of the December 31st of the 5th year of the plan holder's death, but you can do it over a period of 5 years and take the required minimum distributions as long as you have all of the money in that plan withdrawn after 5 years. That is a non-designated beneficiary that receives funds by way of a probate proceeding because there was no designated beneficiary in the plan, either the IRA or the 401k. Okay? I keep repeating that, but I want you to make sure you understand that, because once we get to designated beneficiaries, it's going to be a lot different. So subsequent to all of this information, and again, you need an estate planner, you need a financial planner, and you need a tax consultant, depending on what your overall goal is, if you're involved in receiving one of these plans, either by way of the plan itself or by way of the stretch trust, which we'll get to in a minute. The IRS then came out with a 10-year rule for non-eligible designated and eligible designated beneficiaries. So now we're staying within this plan, right? The inheritance of the plan. But now we're going from a non-designated beneficiary that receives money by way of probate by way of the 5-year rule. Now we're going to a 10-year rule, and we're going to talk about eligible designated beneficiaries, and non-eligible designated beneficiaries. See why this gets a little complicated, right? So you have a little chart, and you make out the chart the way I'm describing it over here with the non-designated beneficiaries. Now we're going to talk about eligible designated and non-eligible designated, okay? The key word is designated. The 10-year rule that most non-spouse designated beneficiaries like children or grandchildren deal with. And this is called the Secure Act, okay? SECURE, that was passed. And the Secure Act the IRS has confirmed by way of the Secure Act that there are no required minimum distributions as long as the entire inherited IRA account balance is emptied by the end of the 10-year term, again, by December 31st of the 10th year of the death of the plan holder. So any designated beneficiary that is a non-eligible designated beneficiary is subject to the 10-year rule. Okay, so a non-eligible designated beneficiary is subject to the 10-year rule. Non-eligible designated beneficiaries would be what? Non-spouse beneficiaries like adult children or grandchildren. So you don't have any required minimum distributions that you have to take out, but you have to take all of the money out of that plan by the 10th year. If you're a non-eligible designated beneficiary, you're designated in the plan, but you're non-eligible pursuant to the Secure Act, which means you have 10 years. Now, how do you go beyond the 10 years to be able to take out this money and have tax advantages? How do you stretch it out? Well, you have to be an eligible designated beneficiary, right? So because the Secure Act did away with some issues that we just discussed, or expanding the rule, that making it a 10-year rule for non-eligible designated beneficiaries, you can withdraw money over the course of time beyond 10 years if you are one of the 5 classes of eligible designated beneficiaries. And we're going to talk about what those 5 characteristics are, 5 categories. One is a spouse. So a spouse, you can go beyond 10 years. If you're a beneficiary that is not more than 10 years younger than the account holder, okay? So if you're not more than 10 years younger than the person who died, you can go beyond the 10 years. You can stretch out these withdrawals. If you are the account owner's children who have not reached the age of majority, so you're a minor. Number 4, if you're a disabled individual, or number 5, if you're a chronically ill individual. Now, I'm not going to go through disabled individuals or chronically ill individuals because it's a complicated category that really requires you to see the appropriate professional. It involves a lot of intricate input, and you may or may not fit that category. But I wanted you to know in general that you're generally excluding children and grandchildren, right, from this eligible designated beneficiary category. They're non-eligible designated beneficiaries. Unless one of them is a minor, or unless one of them is a disabled or chronically ill individual, right? And of course, the biggest category that includes a designated eligible beneficiary would be a spouse. Again, now we're talking about stretching out the receipt of the monies in this IRA or this 401k plan beyond a 10-year period. You're a beneficiary of one of these plans and you're eligible because you're a spouse, so you're stretching it. You may be a beneficiary under these plans and be non-eligible if you're a child or a grandchild, and then you only have 10 years to take it out, and you can take required minimum distributions under those 10 years, over those 10 years, but by the 10th year, you have to take out all the money in that plan as that beneficiary, as that non-eligible designated beneficiary. Okay, now let's switch gears and talk about a trust. Again, I said at the top of the show, most people don't leave these types of assets in a trust. However, if you choose to do so, you must name the trust as a beneficiary on the IRA or 401k forms, right? And you ask the question, why would an owner of an IRA or 401k want or need to name a trust rather than a person as the beneficiary? The primary reason is to exert control over post-death distributions, thus limiting access to an inheritance. Why? You got a problem, not necessarily a child, but to coin the phrase, a problem child. You got somebody who you don't trust necessarily with the money, who you want to have the money but may not be responsible, who may have creditor problems, that sort of thing. So if the trust qualifies then as a look-through or see-through trust, the IRS will look through the trust and treat the trust's beneficiary as the IRA's direct beneficiary, although the trust remains the direct owner of the IRA. So the trust inherits the IRA to administer the IRA, we're using an IRA in this example, on behalf of the beneficiary that we're stretching out the inheritance over time on behalf of, right? Now, to qualify as a see-through trust, as a stretch trust, as what you might call an accumulation trust, because it's accumulating assets over time and making decisions about the distribution of those assets over time. We've talked about what's required to be an eligible designated beneficiary in order to stretch it beyond 10 years. Now we need to find out, what is it that makes a trust a see-through trust, an accumulation trust? One, it must be a valid trust under state law. Well, okay. It must be irrevocable upon the death of the account holder. No one else must be involved in receiving assets. It must become irrevocable upon the death of the account holder. Individual beneficiaries, number three, individual beneficiaries of the trust must be identifiable from the trust document. Okay, the trust must clearly lay out who the beneficiaries are. 4, the required trust document must have been provided to the IRA custodian, the custodian of the plan, no later than October 31st of the year following the IRA owner's death. So no later than October 31st of the year following the IRA owner's death, the plan administrator must receive the trust documentation establishing this stretch or see-through trust. In addition to the above requirements, only individuals may be considered designated beneficiaries. We touched upon that, where it can't do corporations or companies or anything like that. An important tip: not all IRA custodians permit trusts to be named as a beneficiary. Remember, you're naming the trust now as a beneficiary to this plan, not somebody else, not an individual. The IRA account holder or the 401k account holder, as I mentioned earlier in the top of the show, may have certain restrictions on this. That's why you need to check with the plan administrator. A properly designed see-through or look-through trust is deemed a non-spouse beneficiary and thus must follow post-death minimum distribution RMD rules. So what does this mean? This means now that a properly designed see-through trust can be deemed a non-spouse beneficiary and follow the required minimum distributions if the trust inherits this IRA. So now we talked about the fact that previously you had to be a designated eligible beneficiary as a spouse, right? But if you set this trust up properly and you get the proper professional help, you can design a see-through or look-through trust and deem it a non-spouse beneficiary, right? because the trust is the beneficiary now, not the spouse. But yet you're stretching this distribution of assets beyond the 10 years that only a spouse would be allowed to have under the plan if the spouse was the designated eligible beneficiary, right? So now you're designating the trust as the beneficiary, and you're stretching it out beyond 10 years, just like the spouse was able to in our last example. But now you're having a non-spouse beneficiary because the trust is the beneficiary. And there go, anybody in the trust who's a beneficiary will inherit this money according to the stretch trust and be able to extend it beyond 10 years if it's set up properly and if it qualifies under the 4 requirements I mentioned as a see-through or stretch trust. That's the key. Now, you must take post-death required minimum distributions if you have this trust. So basically, the plan gives the trust the money over periods of time, and the trust then distributes the money by way of required minimum distributions to the particular beneficiary of the trust, right? The trust inherited the IRA. After the owner dies, the IRA balance should not be distributed to the trust. So you never take a plan and dissolve it and then put the money in the trust. Then it's going to be taxable to whoever gets it. Rather, you make upon the IRA owner's death, only the required minimum distributions has to be paid from the inherited IRA to the trust, because the trust is the beneficiary, not the funds from the plan, not the funds from the IRA, but the trust is the beneficiary. So the plan pays the trust the money, the trust pays the designated beneficiaries in the trust the money by way of required distributions over time. That gives you many tax advantages, and of course allows you to control the distribution of these funds if you have a person that you're a little bit worried about. So that's why I say you need a tax specialist, you need a estate planner, and you need a financial advisor to really do this right. So finally, in other words, when a trust is named as a beneficiary, the minimum distributions are required to be made from the IRA to the trust. Bypassing the trust is not allowed. Instead, distributions are made to trust beneficiary following the rules set forth in the trust. So it goes from plan to the trust, because the trust is a beneficiary. The trust distributes to the beneficiaries in the trust. It can be stretched out over a period of time, but required minimum distributions must be made from payments from the plan to the trust beneficiaries. Okay, so this I want you to know that there's a way to pass these assets by way of the plan, okay? Either by probate, where you have no designated beneficiary, or by way of a plan where you have an eligible designated or a non-eligible designated beneficiary, or by way of a trust where the trust is the beneficiary, and then you can stretch this out over time as long as required minimum distributions are made from the plan to the trust beneficiaries. Okay, it's pretty straightforward when you outline it on a little bit of a graph, if you choose to do that. But again, it does require professional help in order to implement the goals that you want to do this in a manner that's going to provide you with tax advantages and with control over the distribution of these plans once you pass, at least to the maximum extent allowable by law. Okay, so I think that does it, Rick. It's kind of complicated. I promised from the last show that we'd follow up with this accumulation, stretch trust, see-through trust notion. But it really involves a lot of planning, and it's not right for everybody, but it could be right for the person who wants to conserve on taxes, and and remember, the taxes are going to be paid by people that have the money, not by you, you're deceased, but also by someone who may have a problem child, so to speak, that they want to control over time. And it's worth it to investigate this if those things are an issue for you. But again, please see a specialist. Okay.
That's
right. And I hope you at least got some of the basics down. That's what the show was intended to do. It was not intended by any means to go into many of the more intricate details that could be involved in setting up this kind of a trust. Because remember what I said, there is that issue of qualifying as a chronic or disabled individual that would have to be investigated by way of how the law sets that out. So anyway, enough said. I don't want to confuse you any more than you might already be. I hope you got the basics down, and we're good to go, Rick.
Awesome. Well, for anyone out there who lost track of who's on first, then you need to refer to a guy like Bill to get the proper guidance. And that's what I got out of this, because I definitely couldn't do this on my own, nor would Bill ever advise someone to themselves, right?
No, but if you follow a chart, Rick, just think about it for a second. If you picture a chart in your mind where you have the plan that you're talking about, the IRA or the 401k, you come down here. If there's no beneficiary in the plan, you go to probate. If there's a beneficiary in the plan, is it a eligible designated beneficiary or non-eligible? Well, eligible would be the spouse. Then you can stretch it over 10 years, the money being taken out. If you're non-eligible, you're a designated beneficiary, but you're non-eligible, you're a grandchild or a child, then you got to take it out within 5 years. Now, if you do a trust and you leave the trust as the beneficiary, then you can stretch it out over 10 years as long as required minimum distributions are taken by way of the plan paying the trust and the trust paying the beneficiaries of the trust. That's really the nuts and bolts of it. And if you lay it out on a graph like that, it becomes very easy to at least grasp and say to yourself, hey, this is something I want to follow up with a couple of specialists to see if it's right for me.
Right. No, it makes total sense if you did it that way. I'm kind of a visual guy, so I need to see that, and then that would
I should have really made a graph. I do have some graphs, and maybe I'll forward them to you. And I don't know if we can post them.
Yeah, we could post them here on the show feed.
So let me see if I have one that would be, because my graphs get, when I make notes, I make graphs that are more intricate than what I'm addressing on the show. And so I would have to see if I can pare some of these down to at least provide it to people who have watched the show, so they get the basics. Remember, folks, on these shows, we provide you with basic general aspects of different types of legal ideas. We do not intend to say this is the way, the truth, and the light, and it's applicable to everybody. Carte blanche. It's not. You have to adapt these principles to your particular circumstances, and you only do that by being made aware of these things on the show. Excuse me. And then saying to yourself, the second step is, hey, I'm aware of this. Now, that's interesting. Let me go and take what Bill said and investigate it with my professionals to get more intricate about it, to see if it's right for me. That's the way you approach these shows. You don't approach them like, hey, you said this and this is the way I think it should be, or the way I tried to do it. No, don't do that. You'll make a big mistake. And that's why we have a disclaimer at the end of the show. Right, Rick?
Right. Okay. That's very good. All right, folks. Thanks for joining us today. Remember, you can always go back and see this episode on any of our platforms here on YouTube or Facebook at Bottle Business Sense Show. You can also connect with us on Instagram, Twitter, and iTunes if you're an audio person. So all kinds of different ways to reach out to the show and listen to previous episodes. So with that, stay close. Yeah, stay close to our Facebook and YouTube page for the next episode that's coming up in a few weeks. And we'll keep you updated as to that. So in the meantime, thanks again for joining us, and we will see everyone again on the next show.
Take care, everybody. Have a good week.